Is UiPath a broken stock, a broken company? What are my thoughts on UiPath, the valuation, where it could go in the future? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. Let's dive right in to understand what is going on. So I recently did a video on crashing stocks, one of which was Salesforce, CRM stock, which lost a bit of its value, around 20%. Last week alone, calling out worsening macroeconomic conditions. UiPath is in a similar boat, I'd say even worse, where the stock price lost over 50% of its value in the last 6 months. Part of this is because of a change-up with management, where you have the co-founder Daniel Dines. He's assuming the CEO job, replacing the one-time co-CEO Rob Enslin. So it's nice to, I'd argue it's nice to see the co-founder Daniel Dines sort of step back into the role, but it is concerning because Rob Enslin was brought on in April 2022, not that long ago, as the co-CEO, coming with, I'd say leadership from Google Cloud and SAP. So that's seasoned leadership. That means you're bringing on someone that could, run the company for years ahead. And he, just from a few months ago, was expected to become the exclusive CEO by February 1st. So this does reflect a significant change of plans, suggesting that the underlying business is not performing the way management would expect. There are real challenges going on with the business. So what are some of these challenges? Because when I look at the annualized recurring revenue, it looks very compelling. Not many businesses post charts like this, talk about 28%, compound annual growth rate. Most recent quarter, it even grew over 20%. Now, you need to look at the consolidated financials. You can see all of the financials for free, this page completely for free at AI Ticker Chat, and you see that their growth rate did decelerate significantly from over 30% to around 16%, and their profit margin swung from a reasonable profit to a sizable loss during the most recent quarter. These are not trends that investors like to see. Meanwhile, underlying share count continues to increase. These are not the trends investors want. I'd argue, as you look at the results, this isn't what investors want to see, because you see management say, hey, look, the reason why we had these challenges is because it's a macroeconomic environment. Mid-market customers are changing customer behavior with large multi-year deals. There's inconsistent execution, which included contract execution challenges on large deals. They talk about some of our growth products just are failing to effectively reach their full potential, meaning their sales strategies aren't working, and that the investments they're making to accelerate their growth have fallen short of expectations. Broadly, this is not good. This is ugly. This is them saying, there's economic problems, there's macro problems, and I think it is worthwhile to call out. Now we've seen, I think, at least four companies call out recently that there are macroeconomic challenges with business-to-business purchases. So could this be the beginning of a recession? No one knows for sure. But to see several companies call this out, it does reflect that companies are saying, hey, where are my profit margins? And if I'm being very serious about my profit margins, maybe I don't want to spend on XYZ software. Maybe that's, Salesforce, maybe that's UiPath, but you are seeing that trend pick up in the last few weeks, which is not good. Now, I'd say this is even worse when you look at their guidance, because they're talking about revenue of around $300 million in the next quarter, around $1.4 billion for the year. If you look at what these figures imply based on comparing it relative to last year, this suggests around, 6-7% growth, which is a real challenge, because you're supposed to say, wait a second, isn't the robotic process automation market, isn't this new? Isn't this, going to be a huge market, potentially impacting trillions of dollars of economic activity over time? Isn't this just such a huge opportunity? For you to only be growing 6-7% is a legitimate concern, because then you're saying, wait a second, maybe you're just growing in line with the market. And if you're growing in line with the market, does that suggest you're just keeping your market share? Are you losing market share potentially? What are the competitive dynamics? Is there the threat that there are so many players competing in this space that it's impacting your ability to grow and your ability to achieve attractive margins? So that was actually one of the first questions they got on the investor call, effectively saying, are you seeing more competitive pressures that are causing customers to churn off or completely drop out of the pipeline? And they said, look, 6-7 weeks ago, we started to see some pressure, large multi-year deals. Some of them shrank, some of them got postponed. We're not seeing this as being from a competitive standpoint, i.e. it's not because of our pricing, it's not because of our features. We still think we're rock solid. We think it's this macroeconomic environment. Customers are a bit more cautious and they do more scrutiny into the deals. So I think this is worth calling out, because if you were to look at, let's say, Microsoft back in the 1990s, when it was a company, similar size to UiPath, similar, not the behemoth that it is today, it had incredible profit margins and it was growing at a faster rate. I think that does reflect that you're looking at a business that had less competitive threats, less competitive pressures than UiPath. UiPath has several competitors, and that makes it tougher for them to grow, makes it tougher for them to achieve these margins. So it is worthwhile for investors to reflect on this as a business, saying, this might be challenging. Now, it's possible there are some existential risks that we'll talk about in just a second. But first of all, is UiPath broken? Where do I think it goes from here? In full disclosure, this is not financial advice. And also a quick plug, recently an Unrivaled Investing subscriber posted in our exclusive Discord that, and this is a direct quote, "I've recently paid my second annual subscription and couldn't be happier. I've profited enough already to cover the next 20 years of subscription." It's not hyperbole. I actually did the math just last week. Eric, another premium member of Unrivaled Investing, commented, this is a direct quote, "Thank you again for your support with my family's financial future. You've been absolutely invaluable. I'm grateful to be on this journey with several members of the Unrivaled Investing community, the whole Unrivaled Investing community. And so if you're interested in compelling investment ideas, come check it out yourself. That's at unrivaledinvesting.com. When I look at UiPath, I see a lot of sales. And that is not what I like to see. I don't like to see a CFO making multi-million-dollar sales over time. I want to see buying. And I just did a video on insider buying. So I'd rather find that type of alignment. Now, I do like that Daniel Dines, the co-founder or one of the founders, still owns significant amounts of the stock. And I see that with the alignment. But when I look at the qualitative aspects of this business, and I use AI Ticker Chat to run the AI analysis, using a product called Scorecard, it gets a fairly low score of 6 out of 10. And I largely agree with its conclusion, which is that UiPath has strong financial health and alignment with shareholders. Daniel Dines owns a boatload of stock, supported by substantial cash and no debt. I mean, this company has over $1 billion in cash versus nearly $6-7 billion market cap. So that is a lot of cash. The challenge is that, they need to execute and they need to improve profitability and, they need consistent execution. And with profitability and improved execution, stock price could do, it would improve the quality of the business. And I strongly agree with that. When I think about the potential returns for UiPath in the future, this is a hypothetical framework. Of course, stock price can go higher or lower. I think it is important to reflect on the fundamentals, and that their current profit margins are nowhere near this 25% rate. And this does reflect a deceleration in the business that I don't like to see. The multi-year perspective assumes that they're able to continue to grow at a teens rate. If you have this, where they can deliver on this range of execution of, let's say, teens growth and significantly better profit margins than where they are today, then I think you could have a stock that's up several 100% in the years ahead. I think there really is that possibility, especially because I'm not even factoring in the cash on their balance sheet in this framework. Oftentimes I do, but you're talking about a business at 4 times ARR. I'd argue that's not on the if you were to have a spectrum of, let's say, deep value and crazy bananas expensive, I wouldn't put it at deep value. I'd put it as like cheapish. The question is there existential threats to the business, whether or not it's competitive, whether or not that's technological, that will keep it in that cheapish bucket because that execution won't happen? For example, Microsoft has talked about how they're rolling out an AI feature that'll effectively do a screen grab every few seconds. So that way it can track your progress, and that'll be something they roll out to enterprise customers. That's something if you want it installed. That's not, a deep state, Satya Nadella is watching over your shoulder. That's not the case. It's saying, hey, can we help with your productivity? So I just wonder if the whole robotic process automation aspect and where AI is going, does this mean that their value proposition becomes increasingly challenged? I don't know. It's not clear to me that for sure this gets disrupted in the future, by better and better AI solutions coming out. But I think it is worthwhile to track. And it is a fine line between saying, oh, this is a macro concern. And by the way, customers are saying to themselves, why don't I wait 6 months to a year because maybe I can get an even better AI solution at a much lower cost point in the future. And that's been the whole trend with AI, particularly, which is that, hey, it's all about, you're paying the same amount, but you're getting you're getting a much better model, and it's faster, and you're able to, process more tokens. So I would say this is a very challenging position for UiPath to be in. So it's not personally right for me in my own personal investment journey at this point for UiPath. I don't own a stake in UiPath. Could it work out? Absolutely, depending on that execution. If it works out way better than, if it's in line with the sort of the high case that I just laid out, wouldn't surprise me if it's up several 100%. Or also wouldn't surprise me if someone like a Salesforce says, hey, why don't we buy them? Someone like that, a serial acquirer say, hey, let's buy them. And I don't think their valuation multiple is that crazy expensive, 4 times ARR. So it really comes down to that existential of, do you think the robotic process automation market will change significantly, let's say over the next 5 to 10 years, such that their pricing comes under pressure, or that there are alternative solutions that folks go, do I really need UiPath? Because maybe this slowdown isn't just macroeconomic, even though at this point I strongly suspect it is. Or is it customers saying, do I really need this? Now, I personally, do find compelling ideas, with frameworks similar to UiPath. For example, recently I called out to my subscribers a stock growing closer to 30%, which is significantly better, multiple better than UiPath, trading around like 15 times earnings for this year. So it is possible to find these things, but it's just tricky. And so I think it's important to recognize, like, okay, UiPath, has the cash balance you want, has the founder alignment. Management suggests that they will be free cash flow positive this year. The problem is a lot of it's from stock-based compensation. So it's possible to find the great companies, but the challenge is like, hey, are you sure about the existential risks? How come management's not buying stock for themselves? So you see aspects like this, and it's just too hard for me at this point. Would not surprise me if it works out well from here. And I'd absolutely love to hear your take in the comments below. Thanks so much for tuning into Unrivaled Investing.